$2.38 million. That's what one entrepreneur paid the IRS when he sold his software company in 2018. Capital gains on a $10 million exit. Standard transaction, standard taxes. 6 months later, at a private equity conference, he learned about QSBS, Section 1202, the qualified small business stock exclusion that would have made that entire $10 million federal tax-free. Nobody mentioned it. Not his CPA, not his attorney, not his investment banker. $2.38 million gone because nobody explained 5 simple requirements at incorporation. Here's what burns. QSBS isn't new. It's been in the tax code since 1993. Congress created it specifically to help entrepreneurs, yet most business owners only hear about it after they've already missed the window. Think of QSBS like a first-class upgrade that's available to every entrepreneur. But the airline never announces it. You have to know to ask, and you have to ask before takeoff, not when you're already at cruising altitude. The exclusion is massive. We're talking $10 million in federal capital gains completely tax-free, or 10 times your basis if that's greater. Stack it with trusts, and some families have sheltered $50 million or more. But here's the thing, QSBS is like a combination lock. You need all 5 numbers in the right sequence. C corporation, 5-year hold, qualified business, original issuance, under $50 million in assets. Miss any single number and the vault stays sealed. As you probably know, the difference between paying 23.8% federal tax and paying 0 isn't just about the money. It's about what that capital can do next. Whether it compounds in your family's hands or disappears to the treasury. Strategy 1. The Day 1 Foundation. Let's start with what nobody explains clearly. The specific requirements from incorporation. Think of QSBS like building a house. You can't add the foundation after the walls are up. The structure has to be right from the first day, or the whole thing becomes a very expensive retrofit. First, you need a C corporation, not an LLC, not an S corp, a C corporation. This trips up most entrepreneurs because everyone defaults to LLCs for flexibility, but QSBS requires C corp status when the shares are issued. Now here's where it gets interesting. You can convert an LLC to a C corp and still qualify, but it's like restarting a marathon at mile 0. The 5-year clock doesn't start until after conversion. So if you're 3 years into an LLC and thinking about an exit in 2 years, you're already too late. Second requirement, the corporation needs less than $50 million in gross assets when issuing shares. Not net assets. Gross assets. Think of it as a weight limit on a bridge. Once you cross it, no new vehicles can qualify, though the ones already on maintain their status. Third, you need original issuance. The shares must come directly from the company to you, not from another shareholder, not from the secondary market. Direct issuance, like water from the source, not from a bottle that's been passed around. Fourth, active business requirement. At least 80% of assets must be used in qualified active businesses. Manufacturing, technology, wholesale trade, these qualify. But professional services don't. Medical practices, law firms, accounting firms, financial services, all explicitly excluded. Restaurants and hotels are also out. It's like a VIP list where entire industries aren't invited. The smart play? If you're starting something that could scale, incorporate as a Delaware C corporation from day 1. Issue founder shares immediately. Document everything. The cost difference between an LLC and C corp setup is maybe $2,000. The tax difference on a successful exit? Millions. Strategy 2. The trust multiplication effect. Here's what sophisticated families figured out. QSBS is like a coupon that each family member gets to use once. Each taxpayer gets their own $10 million exclusion. Your spouse gets $10 million. Each of your kids gets $10 million. Theoretically, a family of 5 could exclude $50 million. But here's the catch. You can't just pass these coupons around. The exclusion only applies to original holders. It's like a concert ticket with your name printed on it. Non-transferable. So how do these families stack exemptions? They issue shares to trusted incorporation. Think of it like reserving seats at a restaurant before it becomes impossible to get a table. Grantor trusts where you're treated as the owner for tax purposes. Non-grantor trusts for children. Sometimes dozens of trusts, each holding original issue shares. One technology founder set up 7 trusts before incorporating. Each trust subscribed for shares at pennies per share. When the company sold 8 years later for $72 million, nearly all of it was sheltered. The family kept $68 million instead of $51 million after tax. That's $17 million in tax savings from spending maybe $50,000 on trust formation and legal fees, like buying insurance that pays out 340 to 1. The complexity comes in trust structure. Grantor trusts are simpler. You pay tax on trust income, but QSBS flows through. Non-grantor trusts need their own tax returns, their own books, potentially their own state filings. And if structured incorrectly, you could trigger gift tax or lose QSBS treatment entirely. One wrong move and your house of cards collapses. This isn't something you figure out yourself. You need attorneys who've done this repeatedly, who understand both trust law and Section 1202, who can navigate state-specific issues, because while federal tax disappears, state treatment varies dramatically. Strategy 3. The state arbitrage reality. California doesn't recognize QSBS. Neither does Pennsylvania. You could have perfect federal qualification and still pay full state capital gains. It's like getting a passport but being told certain countries won't honor it. Texas has no income tax, neither does Florida, Nevada, or Washington. Move before you sell, establish residency properly, and you keep the state portion too. Think of it like this. You're holding a winning lottery ticket. You can cash it in California and pay 13.3% to the state, or you can cash it in Texas and pay 0. Same ticket, same winnings. Different rules based on where you stand when you claim it. We're seeing entrepreneurs establish Texas residency 2 or 3 years before anticipated exits. Not just changing their driver's license, actually moving, buying homes, registering to vote, establishing local relationships. Because California will absolutely audit your residency claim when millions are at stake. They're like a jealous ex who goes through your social media to prove you haven't really moved on. One founder moved from San Francisco to Austin 3 years before his exit, maintained his California house as a rental property, visited a maximum 120 days per year, kept meticulous records, plane tickets, credit card statements, utility bills. When he sold for $34 million, California tried to claim tax on the full amount. His documentation won. He saved $4.5 million in California taxes on top of his federal QSBS exclusion. But timing matters. Most states require substantial presence before they recognize residency change. California looks at where your family lives, where your doctors are, where you bank, where your social connections exist. Moving 6 months before selling rarely works. It's like trying to establish a new identity. The details matter more than the declaration. The sophisticated approach? Plan your geography alongside your business. If you're building something significant in a high-tax state, consider establishing operations in Texas or Florida early. Build a legitimate business presence there. Then residency change becomes natural, not engineered. If this is revealing strategies you haven't seen before, subscribe to Smart Modern Wealth. We decode what the top 1% actually does with their money. Not theory, but executed strategies from real family offices. Now, let's talk about why most people fail with this. The biggest QSBS failure? Learning about it too late. It's like discovering there was a VIP entrance after you've already waited in line for 3 hours. So here's your action framework. If you're pre-incorporation, set up a C Corp immediately. Issue founder shares to yourself, spouse, and trusts. Document qualified business activities. Your cost is under $10,000. Your potential savings are millions. It's like buying a $10,000 insurance policy that could pay out $2 million or more. If you're in an LLC but less than 2 years old, consider converting now. You'll reset your holding period, but if you're building something significant, 5 years from now, you'll thank yourself. Run the numbers. If your exit could exceed $5 million, conversion probably makes sense. Think of it as switching trains. You lose some time, but you end up at a much better destination. If you're 3+ years into operations, it might be too late for founder shares, but you can still issue new shares to family trusts if you're under $50 million in assets. These need their own 5-year holding period, but better to start now than never start. Like planting trees. The best time was 5 years ago, the second best time is today. If you're already in exit discussions, you've missed this window, but use it as education for your next venture. Most successful entrepreneurs build multiple companies. Structure the next one properly from day one. Consider it expensive tuition in the School of Tax Planning. And regardless of stage, verify your business qualifies. Service businesses are out. Get written confirmation from tax counsel that your specific operations meet the 80% active business test. One audit destroying your QSBS qualification after you've structured everything around it would be catastrophic. Like building on sand instead of bedrock, everything looks fine until it doesn't. Smart modern wealth doesn't leave $2.38 million on the table. They structure from day one, plan their geography, stack their exemptions, control their timing. You just learned how to shelter $10 million or more from federal tax, legally. But here's what else these families do. They skip the 401k entirely. While you're capped at $23,000 per year, they're moving $265,000 annually into protected accounts. Accounts your CPA probably hasn't mentioned. Accounts that make the 401k look like a toy. We'll show you exactly what they're using instead and why their effective tax rate is often lower than their secretaries. Watch now.